So after the dot-com bubble crash, between the years 2000 and 2002, which saw NASDAQ drop by 79%, I was increasingly frustrated and disenchanted with Wall Street. Wall Street ended up paying incredibly large numbers of fines in their role, the dot-com bubble. Effectively, they put out fake research to get investment banking business, which is incredibly. The fines were essentially an admission of guilt for effectively lying to investors about the safety of these issues. So I started looking for new research after the dot-com bubble and found gold. So we started buying gold at 400 and recently traded at 5,600. So it's been good, but um, the fact of the matter is gold went up for 12 straight years, and it had a pretty significant dip during the 2008 financial crisis, but we're pretty well prepared for that. I mean, our research was showing that there was going to be a likely recession and a major correction in the stock market. Um, so we were short the S&P and some other stock market indices. And even though our gold positions went down in '08, clients still made some money, which felt great because the Dow was down 57. We did not know the extent of the crisis of, regarding '08, being in, the banks were involved with credit default swaps and other derivatives and the sort mortgage banking crisis that ended up melting down nearly the entire financial system. All we saw was the recessionary impact, um, especially with real estate. And it really bothered me that we didn't understand the deeper picture. Um, but since we had success with it, I mean, I guess I just chalked it up to I'll know better next time. But the lesson in that story, quite frankly, is that if you have success, you're less likely going to examine why and to what degree there was an element of just good fortune or luck, versus if you have a problem or an error, you're far more likely going to study what caused that and get it corrected. So you learn more from your mistakes than you do from your lessons. And we did. We had a problem in 2018. Gold, which had been amazing for 12 consecutive years, entered into a correction, and our research did not pick up on that correction. I did start looking around to figure out, who did pick it up, and one of the people that did pick it up was Martin Armstrong, and and Martin uses cyclical research, and something I was not familiar with at the time. So I started to study it, and I was very quickly amazed by his forecasting, and his professional track record well, to put it mildly, stunning. So when people ask about like, Marty's track record, his published track record as the hedge fund manager for Deutsche Bank averaged 39% per year, which is effectively double what Warren Buffett's performance has been. But even what's even more amazing is that during that public hedge fund tenure, Martin's average drawdown on an annual basis was just 1%. In other words, his portfolios made a lot of money and rarely did they go down much, if anything at all. So again, compared to Buffett, I mean, just again, case in point, the 2008 financial crisis, um, you know, Berkshire Hathaway, Buffett's stock, went down about 50%, and it took about 5 years for the stock to recover. So that's a pretty significant drawdown, 50%. So when we started getting involved with Martin's research, I mean, it became really curious about, what would it take to amass a track record that was better than Warren Buffett's, a person that most people will say is the most successful investor in the world. That's obviously not true, but it's what people believe. And the answer, quite frankly, is, one way you can do it is to sell highs and buy low, something that Buffett historically never really did. Now, he does occasionally sell and he'll typically hold a lot of cash when his valuation work indicates that stocks are overvalued. So as a recent example, in May of 2026, Berkshire Hathaway is holding almost 400 billion in T-bills. Now, he had a cash hoard in the '08 financial crisis as well, which he invested at the lows. And obviously, those investments were made at a very good time, and he made a lot of money on that. But again, his overall stock, the value of Berkshire Hathaway stock, did decline by 50% and took 5 years to recover in the '08 financial crisis. So, as to the answer, the key question is like, how do you beat Buffett long term? You sell highs and buy lows. That's how you do it. And that's what's possible once you understand how Marty's cyclical models function. Once you understand how the models function, it applies to every market. So you do not need to be an expert in like coffee or orange juice if you're interested in commodities or stocks versus bonds. The model applies to all markets the same way. So learn the model and you'd apply that to the markets that you're most interested in trading or strategically investing in. Thanks for listening.